Oh dear, sorry. I forgot to unmute. Sorry. I forgot to unmute. Sorry. Now it is audible. Vishali, Sheikh, Shahid. Okay. I'm sorry. I forgot to this unmute. I understand it's quite irritating, but I forgot. So okay, let's start again. So these are the questions which they have asked on the topic of what? Topic on. They have asked this question on the topic of monetary policy. Right. So these are the certain questions they have asked on the monetary policy. If you will see all these questions, the first question itself, which is mentioned here, the first question which is mentioned here, this is the lengthiest question because this question is in three parts. First, they are asking the cause and consequences of inflation. Then they are asking what are the initiatives and measures taken by RBI to contain it. Then they are asking in this context, discuss the relevance of inflation targeting in India. Right. So technically, this is not about just a monetary policy. In this question, they also have asked about inflation. Right. So inflation targeting is a target of central bank, but central bank also has certain limitation. So actually, this is very good question. Right. This is very good question, and this question deserves at least 15 to 20 marks. Right. This question cannot be asked in 5 to 10 marks kind of the thing. That deserve a long answer because this is going to take too much time to answer. Fine. So it's a essay like question. So I'll come to that point. In the second question, they have asked the first question they have asked in the three parts, whereas if you see the second question, explain monetary policy and type of monetary policy. Straightforward question. Straightforward question they have asked. Explain monetary policy and types of monetary policy. What are the various instruments of monetary policy used by the Reserve Bank of India? Various instruments of monetary policy used by the Reserve Bank of India. Quite straightforward question. Is monetary policy is able to achieve to maintain the price stability while keeping in mind the objective of growth during the current COVID crisis? Right. So here your answer is going to be more analytical in the nature. In this question is straightforward where you have to present certain facts related to monetary policy. But in this question, the third question which they have asked, in this third question, the question is not straightforward. The question is going to ask itself about the monetary policy's credibility. Fine. So this question is on credibility of monetary policy. So a little bit more analytical in the nature. Again, fourth question, critically examine the role of RBI in maintaining the financial stability under the new regime of monetary policy. Right. So under the monetary policy regime, new monetary policy regime, maintaining the financial stability. Right. Maintaining the financial stability. Again, this is more analytical in the nature rather than factual in the nature. And the next question is what makes monetary policy ineffective? In a short run, explain. Right. So this question is not just a factual. Again, this question is analytical in the nature. What it means that after analyzing all these questions, we can draw this analysis from these questions. Whenever they are going to ask a descriptive question from this topic, which topic? Monetary policy. More and more chances is they are going to ask an analytical question and not what? Factual question just. Means not just a factual question. The more probability is of asking an analytical question. So when the question is going to be analytical in the nature, more explanatory in the nature, then you must have a good command over that topic. Otherwise, it is going to be very difficult for you to write. For example, in this question, all of this question, the easiest one is what? Explain monetary policy and types of monetary policy. What are the various instruments of monetary policy used by RBI, right? So it's a most simple question. Whereas they are asking here, critically examine. Generally, this kind of the word we do see in the UPSC exam, but here they also have used critically examine the role of RBI maintaining in the financial stability, right? So, just for your knowledge, whenever you will see this term, critically examine, it doesn't mean that you have to criticize, right? It doesn't mean that you have to criticize, because with this term critically examine, sometimes a student perceive that now we have to criticize the thing, right? So here the question is critically examine the role of RBI in maintaining the financial stability under the new regime of monetary policy system. So you have to analyze the pros and cons both, right? You have to analyze pros and cons both when you are going to do the critical examine like question. Fine. Examine and critical examine. Examine what is there, you have to examine. Fine. What are the things there, you have to examine. But when the question is like critically examine, then the question, suppose that for here, the role of RBI in maintaining financial stability. Suppose question was just remove this what? Remove this critical term. Just remove this critical term, and question was examine the role of RBI in maintaining the financial stability under the new regime of monetary policy system. If the same question is going to be asked there and they have not used the term what? Critically examine, then how you are going to write an answer? And if they have mentioned this term critically examine, then how you are going to write an answer? See the difference. Critically examine and examine. So when you are going to examine, when you are going to just an examine, what you have to do, they are asking the role of what? The role of RBI in maintaining the financial stability. So you have to answer, means answer is in three part: intro part, then body part, and then conclusion part, right? Intro, body, and conclusion part. Fine. And they are asking what? They are asking role of RBI in maintaining what? Financial stability, right? So your intro, the intro of this question will start with what? Financial stability or role of RBI? With what you are going to start? Intro. Good evening, Vikulp. Good evening, everyone. If they have asked this question, critically examine the role of RBI in maintaining the financial stability under the new regime of monetary policy system. What will be the better? Whether you are going to start with the role of RBI or you are going to highlight first the importance of financial stability. What will be the better choice while answering this question? Role of RBI. Okay. Vidisha is saying that the role of RBI. Any other person who want to answer this question? What you will prefer? Financial stability. Financial stability. Saikat, financial stability. Sunny Singh, financial stability. Venkat, financial stability. Vidishi has changes option. No, financial stability, financial stability, financial stability, and then the role of RBI in it. You have to start with role of RBI first. In fact, you have to write about RBI first. RBI established on 1st April 1935 on the recommendation of such commission, Royal Commission on Currency and Finance, with an objective to work as a central bank, provide a financial stability in the context of what? Why RBI was established? There are many people here in this lecture. In the detail I explained you why RBI came into the picture, the currency management and the exchange rate stability. The primary objective when RBI was established was two objectives, right? The currency management and bringing the exchange rate stability. So the inception of RBI was happened for the purpose of stability and management. So you can mention there the very inception of the Reserve Bank of India on 1st April 1935 on recommendation of Hilton Young Commission or Royal Commission on Currency and Finance. The role was assigned to RBI first was currency management and putting the exchange rate stability. So since the very inception, RBI is looking over the various responsibility. However, the primary responsibility of Reserve Bank of India is to maintain the stability in various domains of finance, economy, and banking. By independence, 1947, RBI was nationalized and its role over the economy, finance, and banking has increased with respect to a role of regulator in order to provide the stability in the financial system. So RBI play a very important role in the maintenance of financial stability in the Indian economy. So that is going to be what main theme. That is going to be main theme of your introduction when you are going to start this answer, or whether you are going to start intro of this answer. So in the introduction, both are going to be same. Put more attention on what? RBI, and then you have to drag yourself towards where? RBI's role in the financial stability. Right? So is it clear why we have to first in introduction, why we have to mention RBI? Because the reason why RBI came into the picture was to maintaining the financial stability. So since beginning it was assigned to maintain the stability in the Indian economic context. At that point of time when the RBI was introduced in the Indian economic system have two major work, maintaining what? Currency management and the foreign exchange management. These are the two important role was there, and both were assigned to whom? Reserve Bank of India. Okay, got it. Why you have to write with what? Why you have to start with RBI's role? So you are going to start with RBI's role, and in that role, the most important role is to what? Maintain the financial stability in the economy. Right. Now, after introduction, when you are going to write answer, you are going to write an answer for both critically examine and examine. Again, after intro, you have to mention how RBI play a role in financial stability. Right? This is you have to highlight in what? Body of your answer. This is what you have to highlight in the body of your answer when you are going to write this question. Right? So how RBI do that thing? Right? So you have to must mention how RBI is playing the role in the financial stability of a system. Right? Financial stability of a system. How RBI is going to play a role there. Right? Or how RBI play a role for financial stability in this economic system. So the most probable mistake students are going to commit here is they are only going to focus on what? RBI's role in maintaining what? Inflation through what? Monetary policy. So most of the students are going to make this mistake. What mistake? Maybe they are going to write only on the RBI's role in the maintenance of what? Inflation, maintaining the inflation in the economy. But here they are asking not just an inflation, they are asking about what? Financial stability. So just financial stability is not just limited to where? Controlling the inflation, but financial stability also include vibrant banking system that is less prone to risk, right? So vibrant banking system is also an important constituent of maintaining the financial stability. For example, the crisis which world economy has seen in 2007 and 8, it was generated through what? It was generated because of what? It was generated because of banking crisis, right? So somewhere, somehow, the banking system is controlled by what? Central bank. So RBI means their central bank, American Central Bank, was also responsible. It has let allow the financial crisis have to be happen in the US economy, right? So for financial stability, a vibrant banking system is also important constituent. Apart from that, you can mention that ki RBI have to push growth and development agenda in order to stabilize the financial system, right? So where the money is excess in the nature, that money should be absorbed from that area and it should be provided to that area where there is a acute shortage of liquidity. For example, in the services sector of India, there is always over liquidity is available, whereas agriculture related sector is always a deficient of liquidity. Most of the liquidity in the agriculture sector, it is provided by whom? Government only. So that's why RBI over the years through NABARD, then later on NABARD was a separate institution. Earlier it was working under the guidance of Reserve Bank of India. So over the years, RBI has provided the requirement of the various part of the economy. The reason is what? The reason is to make your financial system vibrant and stable in the nature. So all these things RBI has did over the year, and you have to mention in the body of answer while writing on what? While writing this part. Which part? Examine the role of Reserve Bank of India. You have to write this part. Now, in this question, you wrote all each and everything how RBI play an important role. Now in the concluding remark, you have to say that ki RBI is the most important element in the Indian economy as a regulator, and with his wide area power, role and function, RBI make the things possible when it is related to providing the stability in our Indian financial system through as a banker bank, through bank to the government, through lender of the last resort, and executing the monetary policy mandate given by monetary policy committee. So all these way RBI play a role to maintain the financial stability. This is the answer for what? This is the answer for this question where you have to just examine, not critically examine. Fine. This is the way how you have to write your answer. But when you are going to write a critical examine, then introduction, role of RBI played, role played by RBI you have mentioned. Immediately after that, you have to write, despite RBI play a very important role to stabilize a financial system, though there are certain externalities involved here. though there are certain externalities involved here which make RBI as an important institution, but RBI alone himself is not able to provide the complete stability to our financial system. Government and other regulators like SEBI also have to play an active and important role in order to provide the financial stability in our economy. For example, if any financial crisis is going to be generated because of the meltdown of our market, then in that case, RBI himself is not sufficient in order to provide the stability. Here, government and SEBI also have to play an active role, right? Whereas if the growth is not being there, and that's why our financial system is getting unstable, then again government have to play an active role providing the stimulus or various packages to different constituent of an economy in order to help them, like we have seen during the COVID crisis, where RBI and Government of India work hand in hand, providing the all kind of the necessary requirement at government level as well as RBI at its own level in order to maintain the stability in the system. So we can say that yes, RBI do play an important role while stabilizing our financial system. But here, government and other regulators like SEBI and Finance Ministry also have to play an active role in order to assist RBI to make our financial system stable. Right. So, what is the fundamental difference between examine and critical examine? In examine, you just go there and find it out ki what RBI is doing and how RBI can do in the better manner. But when you are examining the critical examine, then you also have to focus on what? Focus on, apart from role of RBI, while critically examine, you also have to focus on limitations of RBI. Limitations of RBI also. So both things you have to mention. Means in the question where you have to examine intro, from intro you went where? From intro you went to body and conclusion. In intro what you have written? About RBI and its role on what? Its role on financial stability. Then how RBI is maintaining FS through various measures, right? Various measures. Then highlight significance of role of RBI in financial stability. So this is about what? Examine. But if the same question is critical examine, then here introduction is same. But in the body, after mentioning this thing, you have to add what? Limitations of RBI in maintaining financial stability. This is what you have to add here. Then you can go for this part. Which part? The highlighting the significance of RBI for maintaining financial stability. So in this way, you have to write a critical examination. So I hope you got this point, what we mean critical examination. So when we have to do the critical examination, we have to do it the proper examination. Not it like that, like sometimes parents are just giving a praise to their kids. अरे मेरा बेटा तो बहुत अच्छा है, he do lot of good things, each and everything, right? You should be what? You should be more honest while assessing some person. You have to highlight both positive and negative side. So when you are able to bring both positive and negative side, it shows that you have better information about that, right? So if you know some person better than other, how I am going to know this thing? You know better than other else. There is person A and person B. Both are claiming that we know M in the better manner. A is claiming and B is claiming. Both are claiming that I know M in the better manner. A has given the list of positive things, right? And he mentioned 100 positive things about M and 0 negative thing about M. Whereas B, he just presented only 60 positive thing, but at the same time he also bought some around 25 to 30 list about negative thing about M. So now if we have to assess who know better about M, the answer is what? B. Because B is able to put all information, not only just the positive information, he know the negative information also. That means the analysis of B is much better than the analysis of A. So that's why in the sometimes examination they are not just going to ask what examine, right? Examine, they are going to ask to do what? Critical examination. Fine. Critical examination. So this is the way how you can write these answers. Okay. No, you have to provide certain example. You have to provide certain example where the role of RBI is having a limitation, where the role of RBI is having certain limitation. Fine. For example, during the COVID crisis. During the COVID crisis, RBI has increased the flow of money in the Indian economy, but certain things to help out the MSME sector, right? It is government have to step in. RBI cannot do that thing alone. Government must have to step in there so that it can be a proper thing can be executed. So you have to provide an example ki these are the certain limitations of the RBI while maintaining the financial stability, right? And because of these limitations, RBI alone is not able to execute. We need more input from where? We need more assistance, input, and working in hand with respect to what? Government and SEBI in order to maintain the financial stability. In this way, you have to write an answer. Clear? Okay. So just have given you the example of what how to write critical examination and examination. Now come back again to these questions. So the questions whenever they are being asked on the monetary policy or related topic, they are more analytical in the nature rather than just a list of facts and data, right? Though you have to use those facts and data in order to write your answer in the right manner. Okay, so that's why we have to do the proper revision on monetary policy topic. Then we will take these questions one by one and we will answer those questions. Right. So while doing this revision, automatically we are going to answer this question, explain the monetary policy and the type of monetary policy, what are the various instruments of monetary policy used by the Reserve Bank of India. Right. So let's start a kind of revision on this topic of monetary policy. So what is monetary policy? There are many people who already did that part in the live class, there are many people who did that part, not in live class, but later on they did that. So the policy under which supply of money is regulated to control inflation. The supply of money is, what is the monetary policy? The policy under which supply of money is regulated to control inflation while keeping growth rate in the mind is known as what? Is known as monetary policy. Fine. And in India, initially from 1947 to 2016, both growth rate and inflation, both growth rate and inflation was considered while deciding the monetary policy, right? However, under monetary policy framework agreement between Government of India and RBI. So monetary policy framework agreement was signed between whom? RBI and Government of India, and monetary policy committee came into the existence to charge of monetary policy. So from 1947 to till then 2016, right? Monetary policy formulation and execution. Formulation and execution both was with whom? RBI. Now under this framework, which framework? Monetary policy framework. The formulation of monetary policy is going to be done by whom? MPC, Monetary Policy Committee, and it will be executed by whom? Who is going to execute the monetary policy under the new framework? Under the new framework, who is going to execute the monetary policy? Monetary policy is going to be formulated by Monetary Policy Committee, but who is responsible for its execution? FMOD? Governor. What is FMOD? Governor, RBI governor. Any other answer? It is RBI, not just governor. And in fact, most of the decision regarding execution is taken by, right, execution responsibility is with the RBI. And who is the head of RBI? That is governor of RBI, right? And governor with deputy governor. Deputy governor, there are 4 deputy governor and the deputy governor who is in charge of monetary policy. So there is a deputy governor who is in charge of monetary policy, he and governor. They are going to take the responsibility for the execution of the decisions made by whom? Monetary Policy Committee. So Monetary Policy Committee is going to take a decision and these decisions are going to be implemented by the RBI, not by the governor just, right? Not just governor, deputy governor, both are responsible, and especially the deputy governor who is in charge of monetary policy. So both are going to have a responsibility. That's why we do say it's RBI who is responsible for the execution. MPCs consist of not just an RBI. In MPC, RBI representative, governor, and deputy governor, one person who is nominated by the board of RBI, right? Then three independent members are there. So six members are there. So MPCs consist of what? MPC Monetary Policy Committees consist of RBI and government representatives, right? Plus independent member. So MPC is not just to RBI. MPC is a body which is comprised, which is having the representation of RBI, having the representation of government, and some independent expert, right? So they are going to tender their opinion that this should be done, and that decision is going to be made through the majority vote. Once they are going to make this decision, then in order to implement that decision, the necessary action is going to be taken by whom? Necessary action is going to be taken by Reserve Bank of India, right? The Financial Market Operation Department. Financial Market Operation Department, why Financial Market Operation Department is going to take this execution work? Financial Market Department is not going to take this work. It is going to be taken by Monetary Policy Department, right? Monetary Policy Department is going to execute this thing, not Financial Market Operation Department. Okay, so this is going to be happen. Let's briefly discuss about the Monetary Policy Committee. How many members are there? 6 members are there. 1 plus 5. 1 plus 5 means who is one person? That is the governor of RBI. So RBI, effectively, RBI have what means this committee have governor plus deputy governor plus one representative of board of RBI, or in other words, the central board of RBI. So central board of RBI is going to nominate one member. One is what? Governor. Another is the deputy governor. Then one member who is what? Who is nominated by the central board of RBI. 3 members, and 3 members are going to be appointed by whom? 3 members are going to be appointed by the government of India on the recommendation of such select committee, right? So 3 members, governor, deputy governor, and 1 member, what? The 1 member who is nominated by the central board of Reserve Bank of India. So how many members are in the central board of Reserve Bank of India? How many members are in the central board of Reserve Bank of India? $21. Okay, good. 21, that is 1 plus 4 plus 4 plus 2 plus 10. So 1 is governor, 4 is deputy governor, 4 is local board. RBI have 4 local board in all 4 metro cities, means those metro cities like Delhi, Mumbai, Kolkata, and Chennai. So there 4 local boards are there. The director of those local boards are member of this central board. So 1 is a governor, 4 is a deputy governor. These 2 are who? These 2 are representative of government of India, and 10 people are nominated by government of India. These are government officials. These are government officials, and these are who? These are the people who are nominated by the government of India. They are not officials of the government of India. Fine. So this is how the board comprise, and this board is going to recommend one name for what? For MPC. So governor plus deputy governor, and here the deputy governor must be that deputy governor who is in charge of what? Who is in charge of monetary policy? We have 4 deputy governors. We cannot send any deputy governor here. The deputy governor, who is a part of monetary policy committee, he must be in charge of what? Monetary policy committee. This thing should be here. So another nominated, and 3 members are going to be nominated by GOI. But this nomination, this 3 members nomination must be come from where? The search and selection committee. The search and selection committee is going to send the proposal, means the name is going to be proposed by that search and selection committee, and then government is going to take decision on it. And that search and selection committee, which going to send these nominations, that is comprised of mainly 2 people. One is the finance secretary and other is RBI governor, right? So these 2 important people are the part of that committee which send the nomination to government for including of these members. Fine. So in this way, the committee constituted, monetary policy committee constituted, right? And under the monetary policy framework agreement, it was decided to set the charge of inflation 4% plus minus 2%. Initially, this target was set for 2016 to 2021, that is 5 years. But however, again, this target is extended from 2021 to 2026. When this target was first time set in 2016, when this target was set was first time, what Raghuram Govind Rajan said, he said that initially we will target, because at that time, means the year of 2012 to 2015, these were years when inflation in India was somewhere around 8 to 9%. Inflation was reaching towards 8 to 9%. So Raghuram Govind Rajan, in his speech, he said that first target is what? Our first target is to bring down the inflation below 6%. Our first target is to push the inflation below 6%, right? So from 8 to 9, we have to put it down somewhere around 6 or 5.6, means 5 to 6.5. This bracket, 6.5 to 5.5, this bracket we have to put it from where? From 8 to 9%, we have to put in this bracket, right? The real objective is what? Then later on, when we will decide for what? When we will decide the monetary policy for 2021 to 2026, for this frame, we will try to push further it down to 4 to 5%. And over the years, the final target is what? Final target is to bring the inflation under this bracket of 2 to 3% over the long term. So that's why for the long term target, we have set the medium term target for 5 years. So this was the initial vision of the Reserve Bank of India when monetary policy framework agreement was signed. However, by 2019-20, the entire dynamics were changed because of the COVID crisis. So that's why there is no change in the targets, because the effect of COVID is not going to allow economy to recover easily. And in order to make a recovery fast, RBI must have to put more money in the economy. And more money is going to put in the economy, then in that case, it is little bit difficult to control the inflation somewhere around this level, means 4 to 5%. So that's why after various consideration in 2021, again it was set to what? 4% plus minus 2%. Okay. So this is the monetary policy committee, and this monetary policy committee take decision basis on what? Majority vote. They take the decision on the basis of majority vote. So 6 members are there. Governor do not have a first voting right. In the first instance, governor do not have a voting right. Governor can vote only when the vote is going to be, means left on the equal, means there is no clear-cut vote division. In that case, governor can use the casting vote. Casting vote means what? He can vote only when the both sides are having the equal thing. But that is quite impossible, because except governor, there are 5 members. There are 5 members. So governor can vote only when maybe the one member out of this five member, one member is going to vote. He is going to refuse to participate in the voting. Then in that case, 2-2 is going to be there. In that case, governor can vote. So it's very clear under MPC, governor is not going to vote, right? Under MPC, governor is not going to vote. So the person who is in the committee, but he is not going to vote, generally people think that he is having the less power. But actually, when you are not going to vote, then you have more power over to influence the other, right? So maybe the power which RB governor do have before 2016, before 2016 the power held by the governor is not there, but still governor have a lot of influence over this monetary policy committee because he is there. He is a ex officio chairman. Under him the committee is going to have a meeting, so still he have a lot of influence over the monetary policy committee's decision making, right? Okay, now one more thing regarding monetary policy committee. As per the framework agreement, monetary policy committee must meet minimum four times in a financial year, right? In a financial year, they have to meet how many times? Four times. But presently, MPC is doing their meeting on bi-monthly basis. On bi-monthly basis. So what they are doing on the bi-monthly basis, that is not necessary. They have to meet on quarterly basis. But in order to make it more dynamic and more effective in nature, Reserve Bank of India and MPC, they took the resolution initially and they are meeting on bi-monthly basis. Okay. Yashodai, hello sir, I can't buy the course in your app and website also. Okay. So this point is clear. Okay. So on bi-monthly basis, you can do the meetings. Though it is not mandatory. What is mandatory? On quarterly basis, but they are doing on bi-monthly basis and they are doing certain work. Right. Now MPC is going to take certain decisions, right? MPC is going to take certain decisions, and on the basis of those decisions, people have created a theory of what? Neutral stance. Then other is accommodative stance, and third is hawkish stance. So neutral, accommodative, and hawkish. Neutral, accommodative, and hawkish. So monetary policy committee is going to take a decision. While taking a decision, their focus is on what? Inflation. and what the target is set for them, that is 4%, right? Plus minus 2%. Plus minus 2%. This is what they have to make sure that key inflation must be under this bracket. Which bracket? 2%, maximum bracket of 6%, right? Maximum bracket of 6%. It should be somewhere around that. Okay. Those people who are in the session but they have not studied about each and everything, maybe they will feel some difficulty, but I hope most of you already did that thing, a monetary policy part. So it's simple thing is what? Money supply. And role of money supply in what? Inflation, and as well as at the same time economic growth. So when the money supply is going to increase, right? When the money supply is going to what? This money supply is going to increase, means people have more money and they are able to make more demand, right? They are able to make more demands, and in order to fulfill those demands, there will be more production. Fine, there will be more production. That means more employment and income generation. So increasing in the money supply can what? Can stimulate economic growth. But at same time, it is also going to fuel inflation. So because there is more money in the economy, price is also going to rise. If price is going to be rise with 4.5%, the rate of inflation is what? The rate of inflation is 4.5%, and your economic growth rate is 8%. Your economic growth rate is 8%. Simple, if you have income of 100 rupees, right? If you have 100 rupees in your pocket and the price are rising with 4.5% rate, price are rising, suppose 4% or even 4 to 5% rate. So price is increased to how much? 105. But at the same time, economic growth is rising with the rate of what? Economic growth is rising with the rate of 8%. So you have 108 rupees in your pocket, whereas the price increase from 100 to maybe 103 or 104 or 105. So still, even after paying more money, you are able to save some money because the growth rate is higher. Your income growth rate is higher than the inflation growth rate. So despite rise in the price, you are able to not just only fulfill your requirement, but apart from fulfilling your requirement, you are able to save something, right? But if what is going to happen? If the inflationary rate is going to be what? 8 to 9%, and your economic growth rate is somewhere around 7 to 8%. Your economic growth rate is somewhere around 7 to 8%, and your inflationary rate is what? 8 to 9%. Then that growth rate is going to be what? Ineffective. Why? Even if the rate of inflation and rate of growth rate is going to match. How? Suppose that some person is earning 100 rupees, right? Inflation is rising with 9%. Inflation is rising with 9%, and GDP growth rate or the income growth rate is also rising with 9%. So you earn 109, but whatever the extra you have earned from 100 to 109, the extra you have earned 9, but that same amount, all the amount you have already paid. for just fulfilling that requirement which was earlier fulfilled with 100 rupees. Now you are paying 109 rupees. So is there any real growth? No, there is no real growth, right? There is no real growth. That is why growth rate growth rate right growth rate must be supported by moderate inflation. Inflation must be low or moderate, then the growth rate is going to be meaningful. Fine. So this is why when the MPC target was set through the monetary policy framework, the target was what? Moderating the inflation. Moderating the inflation, RBI should focus on moderating the inflation. Fine. Now, RBI have to look over what? Inflation. And we have to discuss what is neutral, accommodative, and hawkish stance, right? So neutral stance means what? Neutral stance means accommodative stance and hawkish. So till then, what I explained is clear. Though till then, now what I have explained is clear. Okay. So first understand what neutral stance mean. What is the meaning of neutral stance? Suppose inflation which was earlier 4%, right? Inflation which was earlier 4%, it starts rising from 4%, it reached to 5%. And when it reached to 5%, MPC start doing an analysis. कि inflation is rising, and at the moment when they are having a discussion, suppose that they are having a discussion today is what, 28th April is a date, and today they are having a discussion on what situation in the economy, and they saw that ki inflation has rised from 4% to 5% in last few days. So this data which they do have today, the data which they are discussing today, that is data of almost 15 to 20 days back, or maybe 1 month old data. So you are discussing 1 month old data, and on the basis of that data, you analyze ki in last 2 3 months inflation is rising with very fast pace. So 1 month back, situation was 5%. That means in the coming months, means right now, the present day situation, like ki inflation is already reached to where? Inflation is already reached to 5.8, or even inflation is already reached to 6%. Now what we have to do? Now what we have to do? Now, on this thing, committee is going to have a discussion. What we have to do? So one member suggested, see, yes, inflation is rising, and the rise of inflation is not just because of excess money in the economy. That inflation is rising because of rising fuel prices, because of Russian and Ukrainian crisis, plus supply chain crisis, right? So these are two other external factors which are responsible for rising inflation. And decrease, if we are going to make an effort to decrease the inflation, then it is going to impact on what? Economic growth of India. Right? It is going to have an impact on economic growth of India. So one member said that. Another member said that yes, I am agree with him. He is saying right thing. But the rest of the member, they are saying that ki, okay, inflation is rising because of external factors, but that is creating a hardship for common Indian. And anyhow, we must have to decrease the inflation, because our goal is what? Our goal is to put the inflation in the bracket, right? So what government is doing, we are not supposed to actively help and support. We must have to maintain our neutrality with respect to our function. Means we are not going to participate in the government's welfare agenda or other agenda. We must focus only on our target, and our target is what? To control the inflation. So I am going to be what? I am going to be not worried with, or not having too much concern about the government kind of the thing, or any international like situation. We are not going to take those things as a consideration. The right now situation is alarming, and we must focus on our mandate, and mandate is what? To control inflation. So we are not going to consider the other factors. We are going to put ourselves neutral with respect to other factors. What other factors? Global supply chain, our government of India is pushing to the economic growth rate. All these are the external factors which are responsible for the inflation, but we are going to consider those factor as a neutral factor, and we are going to focus only our job, that is to bring down the inflation. So when RBI is going to be what? RBI is going to take a neutral stance, and inflation is rising, and RBI is going to take what? Neutral stance. That means what? That means RBI is not going to consider too much government policies, and RBI is going to what? Focus on decreasing the inflation. And in order to decrease the inflation, RBI will start cutting down the supply of money in the economy without considering too much government goals. So you took what? Neutral stance. You took the neutral stance. If RBI said that ki, okay, the situation of inflation is alarming, the situation of inflation is alarming, but whatever we are going to do, that is also not going to help neither economy, not overall situation. And right now the situation is like we must provide certain supportive measures to the government. So as of right now, we must have to not take any adverse action in order to control the money supply. We must accommodate few externalities while in our decision making. So you started accommodating, and you understand, trying to, okay, agreed with the global situation, supply side situation, you agreed with that, and that's why you are trying to accommodate those things while taking a decision. So it is accommodative. So in other words, we can say that when RBI is going to take an accommodative stance, that means RBI is going to cooperate with the government in order to increase the what? Increase the economic growth. And for that purpose, if money supply is going to increase, and it is going to fuel some inflation, but certainly in the comfort zone maximum 6%. So that means what? Inflation is heading towards what? 6%, but still RBI is not taking any adverse action to push it back towards where? 4%. Why? Because RBI want government should more focused and go for more economic growth. So we can say that ki you are accommodating government's effort. But if RBI said that ki no, see, this is not our work. Our work is what? Our work is to put this inflation somewhere here, and inflation is going out of that trajectory, then we have to do something. Neutral stance. Now the hawkish, right? RBI saw that certain activities is happening in the economy, or maybe happen in the economy. So till then now, RBI is concerned with the present level of inflation, right? And they are thinking ki whether we should take a neutral stance, or we are going to take an accommodative stance. Under the hawkish stance, when RBI is going to see that ki there are certain things which is under development, and they may cause rise in the inflation in future, right? They may cause rise in the inflation in future, and immediately RBI started taking certain measures which going to prevent rise of the inflation in coming months, right? So one is RBI is neutral. RBI is neutral and RBI trying to bring down already rising inflation, right? So that is kind of neutral stance. But when RBI is going to say that no, these are certain developments in the economy and they are going to lead what rise in the inflation in coming months, so we are going to take an immediate measures and actions like a hawk. So hawk buzz, he is on what? He is flying on very high altitude, and from where there that high altitude, the buzz or the hawk is having an eye on his prey, and he is continuously looking at that, and he is going to attack on it. Right. So even at the higher altitude, it hawk have an eye on his prey. So similarly, RBI is hawkish. Hawkish means what? Ki RBI know that ki that may come, but you are going to take certain actions even right now in order to bring it down. So that's why it is a hawkish stance. Clear? What is hawkish? What is accommodative? And what is neutral? So when this question was asked, explain monetary policy and types of monetary policy, right? So under the type of monetary policy, you can mention that ki three kind of the stance can be taken by the Reserve Bank of India under the monetary policy. Though in general, though in general, when we say about monetary policy, it is expansionist and contractionist monetary policy, right? Expansionist monetary policy and contractionist monetary policy. Expansionist means monetary policy decision taken by MPC, and under that they are increasing money supply. They are increasing the money supply in the economy, so the expansion of money is happening, right? And under the contractionist, decrease in money supply. So money supply is getting what? Money supply is getting decrease. So that is contractionist and expansionist monetary policy. However, since the inception of what? The inception of MPC, we have what? Accommodative stance, neutral stance, and third is hawkish stance. So neutral and hawkish, these stances, they are basically related to what? They are related to contraction. So if RBI is getting hawkish or RBI is showing its neutrality towards the things, then RBI most probably is going to decrease the supply of money in the economy. Whereas when RBI is going to be what? Accommodative, maybe RBI will allow the further expansion of money in the economy, right? So you got this point ki how accommodative is related to expansionist and how neutral and hawkish stance is related to contractionist monetary policy. Clear? Okay. So we have answered this part. What? Monetary policy and types of monetary policy. What are the various instruments of monetary policy used by the Reserve Bank of India? Right. Regarding the instruments, right? So we say that monetary policy tools. Monetary policy tools, and they are of two types: quantitative tools and qualitative tools. So under the quantitative tools, we have what? We have CRR, SLR, bank rate, LAF, MSF, OM. Whereas they have so these are the tools: general tools, also known as quantitative tools, and qualitative tools, also known as selective tools. Okay, so how we can understand what is the quantitative and what is the qualitative tools, right? For that, you can see that I have bottle in my hand, right? So the size of this bottle, with the size of this bottle, I can assure that I can claim that this amount of water can come into this bottle, right? So the size of this bottle, the entire size of this bottle is going to assure us what maximum or minimum amount of water we can have in this bottle. Fine. So suppose that this is 750 ml bottle, okay, and mouth is also very big. So 750 ml water, right, that can come into this bottle in the quick time. It can come into this bottle in the quick time. But if the bottle sizes remain same, that is 750 ml, the sizes remain same, but the mouth of this bottle is going to be what? It is going to be the size of needle. The mouth of bottle is going to be the size of needle. That means bottle have a capacity to accommodate how much? 750 ml of water. But because the size of mouth of that bottle is of having a needle size, we need huge amount of time to fill that bottle or unfill that bottle. Right? Similarly, if we are going to have a big size mouth bottle, but the bottle have a capacity of under only 200 ml. So the mouth is like this, big mouth of the bottle, right? But the quantity of this bottle is only 200 ml. So doesn't matter with what pace water is going to come and water is going to out from that bottle. Maximum water can accommodated by that bottle is how much? 200 ml, despite what is the size of mouth. So in the case of this liquid, we have to focus on both the quantity as well as flow. So the size of the bottle is going to assure the quantity, whereas mouth of the bottle is going to assure what? Flow. So when we are going to increase the liquidity or decrease the liquidity in the economy, we have to assure both. Suppose that if we are going to what? If we are going to increase liquidity in economy, right? So quantity and flow both must be increased. So what RBI did, RBI, in order to increase the quantity, RBI has decreased CRR, SLR, bank rate, LF, all these rates are decreased. But still RBI have put very strict terms and conditions regarding consumer credit control and marginal requirement. Right. For example, RBI said that okay, we are going to bring down the all these interest rates, right? RBI have put it at the minimum level, and that is why banks also have put those interest rate at minimum level. For example, for home loan, they have interest rate somewhere around 7 to 8%. Now banks are offering home loan at the interest rate of 2%, right? Everybody can go to bank and borrow the money because bank is offering at the interest rate of 2%. Fine. But at the same time, bank is saying that you must bring at least you must bring at least 12 year 12-year income statement. Last previous 12 years income statement you must have to produce. So minimum 12-year statement you have to produce in order to get that loan from the bank. So bank is offering loan at very low interest rate because RBI has increased the quantity of money in the economy, but still there are very tough terms and conditions under which credit is going to be provided to the customer as per RBI guidelines. So as per RBI guidelines, bank must need how much? 12-year income statement of the consumer who is interested to take what? Home loan, and home loan is at 2%. Home loan is at 2%, but you have to bring 10 years or 12 years. So it's going to be very difficult for the people to take the loan from the bank because generally after 10 to 12 years of income, most of the people have already took the loan. So those who are eligible, they already took the loan and they are paying their EMIs and they are living in their home. Those young people who just join the job, right, join the job and they are interested to take the home loan, they can't take it because you do not have a 12-year of income statement, right? So if you are going to bring it down, the home loan rate, you are going to bring it down. Suppose that ki rate is what? Rate is 7% and RBI want to put it somewhere around 5.5%. So you just need not to decrease those, but at the same time, you also have to ease the certain restrictions which are harsh in nature or which are not very friendly in the nature to allow consumer to get the credit from the bank. Fine. Similarly, when RBI want to prevent people to take the loan, so this is not just sufficient. This is not going to be just sufficient. At the same time, you also have to put strict guidelines in order to what? In order to bring down the supply of money in the economy. Right? So these quantitative and qualitative tools both are going to work in order to execute the monetary policy. So these are the monetary policy tools used by the Reserve Bank of India in order to tame or control the inflation. Right? So, this question now can be answered in the proper manner. Explain the monetary policy and types of monetary policy. What are the various instruments of monetary policy used by the Reserve Bank of India? So, these are the instruments used by the Reserve Bank of India in order to what? In order to control inflation. Got it? This point is clear? Any doubt? Or shall I move forward? Now, just quickly revise what is CRR, SLR, and other quantitative tools. What is CRR? All scheduled commercial banks have to maintain certain amount of their total deposit in the form of cash. That means CRR must be put in the form of what? It should be must be in the form of cash with RBI, right? So CRR must be in the form of cash with RBI, and this is restriction on all scheduled commercial banks. CRR must be maintained by all scheduled commercial banks. So my question for you is there the same restrictions on non-scheduled banks? Those banks who are non-scheduled banks, they also come under, they also have to maintain CRR and SLR. If a bank is a non-scheduled bank, then they have to maintain CRR and SLR. Yes or no? Answer please. Yes, sir. They have to maintain CRR, but not necessary with the RBI. Not necessary with the RBI. What it means that Prachi, not necessary with the RBI. Okay, so most of you, do you agree CRR must be maintained by the non-scheduled banks, right? So most of the people are agree CRR is there for non-scheduled banks. Now the question is CRR for scheduled banks and CRR for non-scheduled bank. Which one is higher? CRR for scheduled bank is higher. For example, CRR for scheduled bank is 4%. Then the CRR for non-scheduled bank is more than 4% or equal to 4% or less than 4%. Decipher is saying that no, but I didn't get this point. In what context you are saying no? So please let me know in what context you are saying no. Let me know in what context you are saying no. CRR for non-scheduled bank is higher, but message is retracted. What will be the answer? Tell me. Nobody is telling the answer. Why? You have to answer this question. See, scheduled commercial banks are having more restrictions and more terms and condition on them. They have to go for what? They have to fulfill the responsibility of public priority sector lending, and other mandates are also pushed on them, right? So they have more supportive role for the economy, right? Because they have to fulfill more obligations in comparison to non-scheduled banks, right? So supervision is higher on whom? Scheduled banks. They have to fulfill more responsibility. That is why against those work done by the scheduled banks, they also entitled for getting easy money. Easy money means the money on less terms and condition from the Reserve Bank of India, and their deposits are having less number of restrictions in comparison to deposits of non-scheduled banks. So that is why if you will compare, you will find that the CRR requirements are both. For both banks, there is a CRR and SLR requirement, but the CRR requirement for non-scheduled banks is higher than scheduled banks, right? So they are higher for the non-scheduled banks. If scheduled banks are having CRR of 4%, so in general, non-scheduled banks have to maintain 100%, 100 basis point more than the scheduled bank. That means it may be 5% for non-scheduled banks, right? So generally, they are more harsh conditions on non-scheduled banks in comparison to scheduled banks. So got this point कि why the CRR for scheduled bank is going to be what? Less than CRR for non-scheduled bank. So this is the logic is being applied while setting the CRR targets for whom? CRR targets for scheduled banks and non-scheduled banks. Okay. So CRR have to be maintained on NDTL, net demand and time liability, right? And on the NDTL, banks have to maintain CRR, and in order to maintain CRR with the RBI, that means what? Bank have to open a current account of the Reserve Bank of India in their currency chest branch. So in every currency chest branch, bank is going to open the account of Reserve Bank of India, and there they have to maintain certain cash reserves, right? And that is going to be the part of bank's CRR, cash reserve ratio. And the CRR have to be maintained on daily basis and on 14th day basis. What it means that daily basis and 14th day basis, it means that as per RBI guidelines, there is no need to maintain. There is no need to maintain your 100% CRR. There is no need to maintain your 100% CRR. If RBI has given a guidelines under that, you can maintain, for example, 80%, or if I have RBI guidelines said that 95%, or RBI guidelines said whatever. So maybe RBI is going to ask you to maintain the 100% CRR on daily basis, or maybe 60%, 70%. That is going to be depend upon the Reserve Bank of India. And time to time, RBI change this requirement whenever RBI have to change the liquidity situation in the economy. For example, if RBI said that no, you have to maintain 100% CRR of your NDTL even on daily basis. That means if your NDTL is what? 100 rupees, then you have to daily maintain 4%, or in other words, 4 rupees. 4 rupees CRR on daily basis. But if RBI said that on daily basis you need to maintain only 60%, you need to maintain only 60%. That means out of 100, you have to maintain 4% CRR, 4% CRR, but only 60% of that 4%. 60% of 4% means your NDTL is 100. That means your CRR is going to be 4, but out of 4, you have to maintain only 60%. That is 2 rupees 40 paisa. That means 1 rupee 60 paisa is going to be free, and it is going to be available for bank in order to lend that money or create some assets, right? But if RBI is going to say that no, you have to maintain 100% only, then in that case you have to maintain entire 4 rupees in your cash reserve and you cannot use any liquidity for any lending and assets creation purpose. So that's why generally RBI say that on daily basis you have to maintain only a certain portion of your complete CRR requirement. But at the same time, bank have to maintain 100% of its CRR on which day? 14th day. So suppose on 14th day banks NDTL went to 400 rupees. 400 rupees. So 400 rupees bank must have to maintain 16 rupees in where? In his RBI's account of cash reserve. In the RBI's account of cash reserve, bank must maintain how much? Bank must maintain 16 rupees. Whereas suppose on 13th day, the 13th day, bank was also having how much? 400 rupees in NDTL. On 13th day, NDTL was how much? 400. So CRR is 4%, that means 16 rupees. But you have to maintain only how much? You have to maintain only how much? 60%. So you must maintain only 9 rupees 36 paisa rather than how much? 14 rupees. But if NDTL is going to be remain same on which day? 14th day. NDTL was earlier how much? 400. On 14th day again it is how much? 400. Then you have to make it how much? 16 rupees complete amount. RBI is not going to let you allow to maintain this amount. On the 14th day you must show the complete CRR, that is 100% of CRR you have to maintain, right? So in this way, RBI need not to change the CRR. RBI need not to change the CRR, the 4%, not required. What you just have to change? The requirement which is meant for daily basis. For daily basis, suppose RBI has allowed you to maintain how much? 60% only. But RBI has increased how much? 80%. So from 60%, they have increased for daily requirement to 80% of the 4% of CRR. Then whatever the liquidity was free, available, cash liquidity was available with the bank. Now bank have to put where? In the cash reserves. So the liquidity is going to what? The cash liquidity is immediately going to decrease. The cash liquidity which is available, it is immediately going to what? It is immediately going to decrease. Right. So in this way, RBI can use CRR in order to increase the cash liquidity or in order to decrease the cash liquidity. Fine. Without changing the number of CRR. CRR maybe remain 4%. CRR is 4%. Earlier it was 4%. Still it is 4%. Fine. But RBI is fluctuating with what? Daily cash reserve requirement rather than fortnightly basis. Fortnightly means 14-day basis. So 14-day basis is remains same, 100% of the CRR. But on the daily requirement, earlier it was 60, now it is 80. That means less cash is going to be free from cash reserves. Got this point? Those who are not able to get this point, this is just a revision. Those people who are not able to get this point, kindly go to the detailed lecture where I have discussed this thing in the extended version. Right, the extended version was there. Here only what? Here only for the revision purpose. Ki how this CRR is going to be used, right? For increasing or decreasing the money supply. Okay. After the CRR, we have another instrument, that is SLR, right? Under the SLR, banks have to maintain certain amount of their NDTL with themselves, not with RBI. Unlike CRR, where the certain amount is have to be maintained with RBI, here certain amount of their NDTL maintained with themselves in the form of what? Either cash or gold or what? Government securities. So in either form, you have to maintain the SLR. In either of the form, you have to maintain this SLR, but bank will prefer to go with what? Government securities, because cash is going to be remain same, and you took the deposit, you have a liability on those deposits, and you do not want to pay the interest on deposits from your own pocket. You took the money from the people, and you are not interested to pay the interest from your own pocket. Then what it means, you want to invest that money, and from that investment you want to repay the principal amount and interest amount of those people from whom you have taken the deposit, and you can also make some profits and fulfill your running expenditure. So that's why banks are not interested to put their SLR in the form of cash. Gold is going to rise, but sometimes due to the fluctuation in the gold price, maybe the asset value is going to also what? Decrease. Whereas government securities are the fixed investments. Fixed investment means कि when you have purchased the government security, there is an assurity of guaranteed return on the government securities. Right. So banks always prefer to invest in government securities when they are going to maintain their SLR. So if government need more money, right? Government need more money, then government have to issue the government securities. I hope you know what security means. A paper which give a guarantee of what? Transaction, that is security. Right. So here I'm not going to discuss the government security in detail. What I am going to discuss, how SLR is going to impact the liquidity in the economy. If RBI is going to increase the SLR, if RBI is going to increase the SLR, then definitely bank have to maintain more government securities with themselves. That means banks have to purchase more government securities. And in order to purchase the government securities, which is going to be provided by whom? RBI. So banks' money is going to park where? In RBI. That means the liquidity is going to decrease with the bank. So that's why generally CRR and SLR, they are inverse proportion to what? Liquidity. They are inverse proportion to what? They are inverse proportion to liquidity. Okay, they are in the inverse proportion to liquidity. If they are going to rise, then definitely the liquidity which is available in the market or in the economy, it is going to what? Decrease. And if they are going to be decrease, the liquidity in the economy is going to what? Increase. And CRR and SLR combinedly known as reserve requirements. Reserve requirements or statutory reserve requirements. So they are the reserve requirements. Fine. So RBI have to implement what? Monetary policy. And under that, what RBI is going to do? Either increase or decrease the supply of money in the economy. And for that, RBI is going to target whom? Banks. Right? RBI is going to target banks in order to increase or decrease the money supply in the economy. RBI is going to target banks. Fine. But now focus on the banks. Banks are going to get money from whom? RBI is going, sorry, banks are going to get money from depositors. Banks are going to get money from depositors, and banks are also going to get money from whom? RBI in the form of loans. Banks are going to get money from depositors. Banks are also going to get money from RBI in the form of loans. So in order to control money supply which is coming to bank, money is coming to bank through whom? Depositor. In order to control depositors' money, that is NDTL, RBI has applied what? CRR and SLR. RBI has applied what? CRR and SLR. In order to control the liquidity which is coming to bank in the form of loans from whom? RBI. RBI uses what? RBI uses interest rate offered to banks. Right? RBI in order, see, RBI have to control the liquidity of whom? Economy. And bank are the most important constituents of an economy, right? So, and banks are getting money from where? Banks are getting money from their depositors and cheap loans available from RBI. From here, banks are getting money. And this money is being invested by the banks in the economy for the various assets creation by the bank. Okay. So if we have to restrict the money supply with the bank, we have to restrict the money which is flowing from depositor to the bank and the loans which is coming from RBI. In order to control the depositor's money, that is NDTL, we have just saw that how the CRR and SLR is going to be work. Fine. Whereas the money which is coming from RBI in the form of loan to banks, we are going to check with what? Interest rates. And generally interest rates are of long term, short term, and very short term. In the context of loan given by RBI to banks, long term means in this context, the loan given by whom? The loan given by RBI to banks for this context, long term means more than 1 year. Short term is up to 1 year. Very short term means 1 to 14 days. Fine. So in that way, RBI offers three kind of the loan to banks, that is based on bank rate, other is LAF facility, under which we have to see repo rate and reverse repo rate, and third is marginal standing facility. Bank rate is a long term facility. What it means that? It means that if bank is going to borrow the money for 15 months, under the bank rate, RBI charge what? Annual interest rate. RBI charge annual interest rate, and you borrowed the money for how much? 15 months. So are you going to pay the interest rate of 15 months, right? Or you are going to pay the interest for 2 years? What do you think? Under the bank rate, bank has borrowed the money. Bank borrowed the money under the bank rate, and that borrowed for 15 months. Whereas under the bank rate, the interest rates are charged on annual basis. Then for how much duration you have to pay the interest? For 15 months or 2 years? Answer please. Venkat saying that 15 month. Anyone else? Two years. See, you have to pay the interest rate for 2 years. You borrowed the money on the annual interest rate. RBI has given you the clear thing. You have to pay the interest rate on annual basis. So if you are going to return that money, for example, if you have borrowed the money from the bank for 48 months, you borrowed the money from bank for 48 months and you are now saying that I want to return that money only in 24 months. Is bank is going to rationalize that interest rate? Maybe bank is going to rationalize, but bank is going to put certain prepayment charges in order to recover that money, right? So bank is going to put the charges. Why bank is putting the charges? Bank has given money to you for what? 48 months, that is 4 years, and you are returning that money within 2 years only. So bank has given the mandate for 4 years, so bank has invested accordingly, right? Bank has invested accordingly. Now you are changing the terms and conditions, but bank is going to penalize you. So similarly, under the bank rate, if you have borrowed the money on the condition of what? Annual interest rate, then you have to pay the annual interest rate of 2 years rather than of 15 months. So that's why bank were facing the problem. Since 1947 till then 1990s specifically till the 1992. Till the 1992, RBI was providing only bank rate. So it is very difficult for a bank to give a loan to industries. It is very difficult for the banks to give a loan to industries for the short term because industries need working capital. They need what? Working capital. Any industry need a working capital. Capital market was highly regulated. Capital market in India was highly regulated. So you cannot use the capital market. Then you can go where? Banks for what? Working capital requirement. And banks are getting money from RBI on the basis of what? Annual rate only. So if an industry is demanding money from bank for 6 months, but that money which bank took from RBI, bank have to pay the interest rate for 12 months. So bank is not going to offer that loan for the 6 month duration kind of the thing. Bank is going to say that we need this higher interest rate. Fine. So that's why it was very difficult to do the business in India because the interest rates were very high. So in order, when we have went for LPG reforms, then we saw that now the privatization is going to increase and private companies need what? Working capital. So in order to provide the working capital, we must have to rationalize what? Interest rates. And how you can rationalize the interest rate? Providing the short term facility where RBI is providing loan to whom? Banks for the short duration. If the short duration loan is available with the bank, then bank can also provide that short term loan to whom? The people who need a working capital requirement. So this is why the LAF facility was introduced, right? Short term lending facility in the name of repo and reverse repo, it was introduced. Got my point? Venkat and Vishwas, why you have to pay the 2 years interest rate? So the bank rate is that rate which you have to pay and where the annual interest rate. See, this is why during the COVID crisis, RBI has introduced what? LTROs, long-term repo operations. So under the long-term repo operation, RBI is offering loan from 1 year to 3 years. For 1 year to 3 years, that means you can borrow for 15 months. Under what? Under LTRO. Earlier, under the repo, you can borrow maximum for 3 months, right? In certain cases, up to 1 year. Up to 3 months to up to 1 year, in the certain cases, you can borrow the money under the repos, right? But during the COVID crisis, there is a lot of problem for the financial system. So that's why RBI introduced what? LTROs. So under LTROs, if bank is going to borrow how much money for 15 months or 18 months rather than 24 months. So you have to pay the interest for 18 months only rather than 2 year. Because if LTRO was not there, then bank who need money for 18 months, they have to avail facility of what? Bank rate. And if you are going to avail the facility of bank rate, then you have to pay the interest rate for how much? 24 months. So this is why RBI has introduced what? Long-term repo operations. So that banks can borrow money from RBI from 1 to 3 years, and they can go with whom? The industry is providing them short-term loans like 1 year to 3 years at low interest rate, right? Understood why the LTRO was introduced. Bank rate and LTRO is clear. Now repo and reverse repo, these things, since the day you have started preparation for banking exam, the thing which you have to go through many times, that is what is repo and reverse repo. When RBI is going to lend the money by RBI to who? Banks. Interest rate is known as repo rate. When RBI is going to borrow money by RBI from banks, interest rate offered by RBI is known as reverse repo rate, right? And the striking feature of this repo and reverse repo operation is what? These operations of lending and borrowings, they are collateralized lending. Because when bank is going to borrow from RBI, bank have to give its government security to whom? RBI. Against that, RBI is going to offer you the loan, right? Similarly, when RBI is going to borrow the money from whom? RBI is going to borrow the money from the bank, then RBI have to give up its government security to whom? Government security to banks, and against that, bank is going to lend money to RBI. And when the tenure is going to be over of repo, right? So suppose bank has borrowed money for 1 month from RBI under the repo operation. So at the time of that lending by RBI to bank, at the time of lending RBI and there is a bank, right? So under repo operations, bank is going to give what? Bank is going to give government security to whom? RBI. And against that, RBI is going to lend the money to whom? Bank, right? After 1 month, what is going to happen? The government security which is held by the Reserve Bank of India, it is going back to whom? It is going back to bank, and bank, in order to return money plus interest amount. Fine. Money and interest amount have to be repaid by whom? Repaid by bank to RBI. if bank is going to fail, if bank is going to fail to repay that money, in that case, that government security is going to be sold by RBI in market in order to recover its money. Right? So this is the collateralized borrowing. Collateralized borrowing between RBI and bank. Collateral is used. What collateral? Government securities which have highest security feature. Okay. Same way in the reverse repo case. In the case of reverse repo operation, RRR, bank and bank and RBI. So RBI is going to give what? Government security, right? And bank is going to give what? Money to RBI. Okay. After 1 month, suppose the duration is 1 month, then after 1 month, what is going to happen? Bank which hold the government security, bank have to return that government security to whom? Return to bank, and RBI is going to repay the money to bank, principal amount plus interest amount. And if RBI is going to fail to repay, which is almost impossible, but if it is going to happen, then bank is going to sell that government securities in market and recover its money. Right. So in this way, repo operations and reverse repo operation work. So obviously, if bank are going to involve in repo operations, banks are involved in the repo operation, they are going to get money from RBI, right? Get money to RBI. Whereas reverse repo operation is going to be participated by the banks, then whatever the money they have, they are going to give it to whom? Reserve Bank of India. So repo operation, it is going to what? It is, if only repo operations is going to be happen, liquidity will increase. Only reverse repo operation, liquidity is going to what? Decrease. Right. If RBI is running the repo operation, under that repo operation, RBI said that we are ready for what? We are ready to purchase the government securities from the bank. That means RBI is going to infuse the liquidity in the economy. Whereas if RBI is saying that we are ready to purchase the government securities from bank, that means RBI is going to drain out the liquidity. So repo operations are being conducted in order to inject the liquidity in the economy, and reverse repo operations are being conducted in order to what? Absorb the liquidity from economy. One concept. Repo operation is going to be conducted to inject the liquidity in the economy, right? So RBI is injecting the liquidity in the economy through what? Repo operation. Suppose that with the interest rate of 4%. So RBI put the interest rate of 4% under the repo operation, means RBI is charging 4% only under the repo operation in order to provide the liquidity to bank. But RBI is going to hike the repo rate from 4% to 5%. If RBI is going to increase the interest rate, that means the borrowing from RBI by banks, it is going to cheap or costly. It is going to be what? Costly. So if it is going to be costly for banks, so banks are also going to make it costly for their customers. And if customers are going to get the costly loan, they will going to take a loan only when it is highly required. That means by increasing the repo rate, you can decrease the flow of liquidity from RBI to banks and from banks to public. So increasing in the repo rate is going to decrease the flow of liquidity in the economy. So sometimes students get confused. So be very clear here. The purpose of repo operation is to increase the liquidity. Okay, and when the interest rates on repo was low, banks were providing what? Loan on low interest rate to whom? Consumers. RBI has increased the repo rate. Now banks are going to get the loan from RBI on a high interest rate. So similarly, banks are also going to charge the higher interest rate with public. Fine. So in this way, you have to keep these two things in your mind. The objective of repo operation is what? To increase the liquidity. Similarly, the what is the objective of reverse repo operation? The objective of reverse repo operation is to absorb the liquidity, right? To absorb the liquidity. That means if RBI is offering 3% interest rate earlier, but now is going to offer 4%. So earlier RBI was giving the interest rate of 3%, now RBI is providing the interest rate of 4%. That means earlier RBI was absorbing the money with 3% interest rate. Now RBI is going to absorb the liquidity with 4% interest rate. Means the liquidity is going to be drained out in the more fast pace from banks to RBI. Okay, that is why whenever the repo and reverse repo rates are increased, what is going to happen? Banks who are lending money from RBI at low interest rate, they have to pay higher interest rate. And if they have to pay higher interest rate, they are going to charge higher interest rate from their customer. Right? So bank will prevent themselves borrowing the money, liquidity will decrease. And because RBI started giving higher interest rate to banks if they are going to park their money in RBI, then whatever money they do have, they are going to give it to whom? RBI. So that means increasing the repo and reverse repo rate, it is going to decrease the liquidity in the economy. Similarly, if you are going to decrease the repo and reverse repo, liquidity is going to increase in the economy. And combinedly, they are known as liquidity adjustment facility, comprise of both what? RR and triple R. Clear? You cannot use the pledge term. Pledge is not required. It is what under the contract. It is the standard definition for the repo. So pledge is not like thing. It's required. Okay. So uh, I had did the revision part of some areas. Few areas are still left. I will finish it tomorrow. Then the rest of the questions, especially what are the limitations of monetary policy, how to answer those questions where they are going to ask with respect to limitation of monetary policy, right? Limitation of monetary policy and regarding inflationary target of monetary policy, how to write those things, I'll let you know in the next session. So in the next session, I'm going to wind up all these questions with the related revision. Okay, and yeah, so tomorrow I will wind it up this monetary policy part, and then we will take another thing. But tomorrow we are going to discuss more critical issues where we are going to examine RBI's ability regarding what? Relevance. RBI's relevance regarding inflation target, limitations of monetary policy, and how that can be more effective. Right. So all these things we will first do the revision, and we will discuss these questions. Okay. So thank you for today. We will meet tomorrow at same time 8:30. Okay. Thank you.